In this episode, we're going to look at the accounting for the sale of merchandise. When we are accounting for the sale of inventory that a company has purchased, we're going to be looking at the recording of discounts and returns and allowances. Sales discounts are a discount offered to customers for prompt payment of their invoice, and returns and allowances are contra revenue accounts. There's a little bit of a difference between how we handle adjustments to inventory and the adjustments for the sales of that inventory. Recall that when we are recording adjustments to inventory, or things that happen after the original inventory purchase that affect the original purchase cost, we directly reduce the inventory account. However, generally accepted accounting principles require us to leave revenues at the original amount recorded at the time the sale is earned or the time the inventory is sold. If something happens after that initial revenue that causes the amount of the revenues to decrease, for instance, a customer takes a discount for prompt payment, or a customer returns some of the inventory that had purchased, or we grant an allowance to the customer for defective or damaged inventory. Those discounts, returns, and allowances are really an indicator that we have kind of lost or given up some of those originally recorded revenues. However, instead of directly reducing the revenue account, GAAP requires us to use contra revenue accounts. These contra revenue accounts are used to record the amount of revenues that we have lost or given up due to discounts and returns and allowances that are decreasing the actual revenues earned. So net sales is really the difference between revenues as we originally earned at the time of sales, less any discounts, returns, and allowances that happened after the initial revenue was earned, resulting in the net sales or the actual amount of sales earned. So for example, on June 8th, ABC sold merchandise that had purchase cost of $3,500 and it was sold for $6,000 on account. They were sold under the credit terms 2% discount if the customer pays in 10 days or the net amount of the invoice is due in 30. When this transaction occurred, there's really two transactions going on. When we sell inventory, we are earning a revenue, which is transaction number one, and we are using up some of our inventory and it is becoming an expense, which is transaction two. So with every inventory sale in a perpetual inventory system, we have to record two journal entries. The first journal entry will be the amount of revenues earned. We earned revenues of $6,000 for the sale of the inventory, and the customer owes us $6,000. So we are increasing accounts receivable with the debit and crediting sales. We also need to record the inventory being used up and becoming an expense. So we need to decrease inventory for the cost of the inventory when we purchased it, and that's the cost of the goods that were sold, or the expense, by debiting cost of goods sold for $3,500. On June 17th, ABC received a check from the customer. The check was for $5,880, and this was in full payment from the sale that was made back on June 8th. Remember, the customer was able to take a 2% discount if they paid within 10 days. They're paying within 10 days, so they are going to take 2% off of $6,000 or a $120 discount. So the customer only needs to pay $5,880. So we're going to debit cash for the amount of cash received. We are decreasing the receivable by the full $6,000 that the customer owed. The discount of $120 means that the original revenues that we recorded of $6,000 have decreased by $120 due to the sales discount. So we debit the contra revenue account for $120. Now let's look at an example of a return and allowance. On June 12th, ABC sold inventory costing $4,000. They sold it for $7,500 on account. The credit terms are 210 net 30. Remember, we have two transactions going on when we sell inventory: revenues earned and inventory being used up. So the first entry is to record the revenue being earned, debit accounts receivable for the $7,500 selling price, credit sales for $7,500. We also record the inventory decreasing. We credit inventory for its cost of $4,000 and debit cost of goods sold for $4,000. June 14th, merchandise that had been sold for $800 at a cost of $470 was returned by the customer. Remember, we are not going to directly reduce the revenue account. We are going to use the contra revenue account to record the lost or given up revenue due to the return. So we need to decrease accounts receivable because the customer is not going to pay us $800 if they return some of the inventory. And they are also going to be debiting sales returns and allowances, the contra revenue account, to keep track of how much revenues were given up due to returns and allowances. Because some of the inventory came back to us, we need to also increase the inventory because we now have it again, and decrease cost of goods sold because that inventory really hadn't been sold, so we need to decrease the expense that we had previously recorded. When we receive payment from the customer for the amount that they had purchased, less the return, we are going to be receiving $6,566. $7,500 was what they originally purchased. They returned $800 of it, so they really only have an account receivable with us of $6,700. They are going to be taking a 2% discount off of the amount owed, so we're only going to receive cash of $6,566. So we decrease accounts receivable by the full amount that is still owed, debit cash for $65.66 to increase, and the discount of $134 is recorded in the contra revenue account to keep track of how much in revenues were given up due to the discounts. So remember, the general rule here is if something happens after the original revenue is recorded that causes the originally recorded revenue to decrease, hence a sales discount or a return in allowance, we use a contra revenue account to keep track of the revenues that were given up due to the discounts or returns. We do not directly reduce the revenue account.